I too want to welcome all of our viewers to our third digital conference. It's a newer educational series for us, and our goal with all of these conferences is to help you get smarter about investing. Now, today's agenda, like Lule outlined, is focused on investing in the future. And to us, that really it kind of felt right, given all the changes and uncertainties that 2020 has served up. We're all looking to 2021 and beyond for brighter days and better investing opportunities. Near term, to be sure, the market does face some challenges. We've got volatility in the market. It's being driven by stimulus negotiations, election risk. We've got mixed economic data. But when I think about the prospects for next year, things look and feel a little bit better to me. The election will be over. Believe it or not, we're going to get past that. We're seeing growth improve in other parts of the world. The coronavirus vaccine is on the way. Corporations in the US are expected to completely make up for the profits that have been lost this year. And I do remain optimistic that the government's going to do the right thing to support consumers and the economy. Anyway, this is just some food for thought as you enjoy the great panel presentations that we have lined up for you today. Now let's get to it. Let's turn to our panel on generational money moves in the time of coronavirus. Look, to be sure, the coronavirus, it's rocked the world. It's caused a lot of us to rethink our lives, especially our finances, right? That could be due to market swings. It could be due to job loss or even quarantine delirium. That is a legit thing. I know I've gone through it. Anyway, this panel, a few of us at Ally Invest, we're going to give you our perspective on all of this and what it means for your money. We'll answer all your questions, though, at the end of our session. So if you're on YouTube, put any questions you have for us in the chat box there. If you're on Facebook or LinkedIn, just add your questions to the comments. This is a very interactive conference, as you saw. We've got some trivia questions going. We're going to be doing some polling throughout the day. And we really are excited and look forward to engaging with you. I hope you are just as excited to engage with us. But anyway, we've got a lot to cover. So let's start before we get to the poll question. Sorry, I forgot to introduce the panelists. On the panel this morning, we have my esteemed colleagues, Brian Overby. He's our senior options analyst, and he's our Gen Xer on the panel. So he's our senior person on the panel. We've got Callie Cox. She's a senior investment strategist at Ally Invest, and she's our millennial. And then I'll also be on the panel contributing, and I straddle the line between these two. I'm a little bit somewhere between millennial and Gen X. I think they're calling that Zennial these days. Anyway, again, reminder, we'll take your questions at the end. But since we do have a lot to cover, let's jump right in with a poll question and get a feel for some of the people that are viewing and talking with us today. So the question is, how would you describe your financial self right now? And you see the question up on the screen. And how you answer it is by going to ally.com/live poll. And you'll see the question again. How would you describe your financial self right now? And your answer choices are confident, nervous, or staying the course. So we'll give you a couple minutes to answer that question. And while you do that, we're going to get the conversation started, kind of set the stage for the day for what our conversation is going to be about. So Brian, I'm going to just kick it off with an overarching question that should cover our theme. What has been the biggest change in your life because of the pandemic?
Well, that's very kind of you to start with the old guy, but in general, being the Gen Xer here, well, one of the biggest things that has happened in my life actually recently, and that's kind of odd being the older person here, but I have a toddler and just one child, and I love him to death overall, but he is 3.5 years old. And because of that, my partner, we decided for her to not go back to work because of the pandemic. Now, ideally, at this age, him being in preschool and her having some time, she would actually be back to work. But we want to have the flexibility overall. So we've kind of, pinched pennies a little bit to be able to make it through this period, hoping that on the other end of this, and by the other end, I think that we have a vaccine or something, where we feel a little bit more confident in where our son can go to school, what might happen in that present. So that was probably our biggest hack is we made that decision and literally we made it probably over the last couple of months as to should she go back to work or should she not? And we decided not to. So we got to pinch some pennies to try to deal with that scenario.
That's great. Well, it's never easy, and I think a lot of people are experiencing different things in this time. So, Callie, what has been your experience?
Sorry, still haven't gotten the Zoom thing down. Sorry. All right. So, first of all, thank you so much for having me on the panel. I'm so pumped to be the young millennial, and I promise I'm good at technology despite what just happened. But yeah, I mean, a lot has changed in my life. I live in Uptown Charlotte. That's the city center here in Charlotte, North Carolina. I live in a small condo with my husband, Matt, and then we did get a pandemic puppy named Ozzy. He's a 17-week-old pug. Oh
Oh
my
my
goodness.
gosh, look at that little guy. So
It's
cute.
Yeah,
awesome.
I think Eric is putting up a picture right now. But we've gone through a lot. We've obviously stayed at home more. Like I said, we live in a really small condo, so we've had to move around the furniture quite a bit to make two office spaces. And dealing with Ozzy, he's been a very cute but a very big life change. So lots of things going on this end.
Puppies aren't as easy as they seem. Their cute faces can be deceiving. I guess for me, I would just say my situation is pretty similar to Callie's. I really had to learn how to manage a work day out of a small apartment in New York City with my husband. That is until I jumped on the very pandemic bandwagon trend thing to do of fleeing the city for the suburbs. We'll talk about that later. But yeah, it's been a very similar experience, I think, to Callie, what you're doing. I would say the downside for me has just been probably increased anxiety when I go out in the public, coming from New York, where everything was shut down for so long, everyone wearing masks and gloves everywhere. It's just, I think it's stuck in my head. But the upside too has been saving money. But that actually, I'll pause there though to take a look at our poll question. Thank you all for participating. Look at this. That was fun to watch. It looks like the majority of you are staying the course. I got to say, Brian, I don't know what you take from this, but I'm a little surprised. I thought we would have more nervous Nellies in the audience. What were you expecting?
Well, if I look at this, the VIX is actually showing a little bit of a different story than what our poll is showing, in that we've seen the VIX index, which is the volatility index that tracks the S&P 500 index overall using those option contracts, just stay stubbornly high. It's up around 29% today. But what we've really seen is on the big upturn, we've kind of had a V-shaped recovery almost all the way back within a month of hitting the lows in March. But we still see the VIX showing a lot of nervousness in the marketplace, up around 29%, stubbornly so, where the mean average in general would be down around 20%, just looking on about a 300-day moving average basis. So overall, when you think about this, we're seeing people are saying they're staying the course, and that's great. That's great to hear, because that's what we'd like to see. If you have the ability to stay the course, is to stay the course in a downturn. But the VIX is showing that there still is a lot of nervousness in the marketplace. And there are some other signs out there, but obviously that nervousness has caused a lot around an election. So we're kind of seeing a little bit of that. And as you mentioned on the beginning, on the top of the show here, on top of the panel, that will go away. But obviously we still have the pandemic that is also causing nervousness. We need a solution there too.
Yeah, that's a good point. That actually is a great segue into the next topic I wanted to talk about is money. And you bring up the point that there is a lot of uncertainty that remains. And, the pandemic has created a lot of job loss in our country. We've been able to add some back over the last several months, but there's about 10 million people that are still unemployed. And that is a staggering number by historical standards. And it's resulted in a lot of American families that have been struggling. So look, the government stimulus checks and boost to unemployment, they were initially helpful, but they ran out at the end of July. We're starting to see signs that some of that money that came in is being spent or being dwindled away. So we're still waiting for Congress to take action around fiscal aid or stimulus. It seems to be a headline every day in the news, and it's been a key market mover lately, Brian, just like you mentioned. So, when I think about money and I think about 2020, it really, I think, has made us all think twice. especially about the concept of an emergency fund. And I wanted to like kind of start the day off with this because it's really easy to push off that emergency fund, building that emergency fund on sunny days when things are great. But it's times like right now, what we're doing here that reminds us why we need to save money for that rainy day that we saw in February, March, April, can possibly are continuing to see today. Now, people in general, this is a fact. They're just not wired to save. We have studies that show that more than 80% of people are not natural savers, and less than 25% use direct deposits to bolster their savings. But deep down, we all know that we should have something set aside for that rainy day, right? I mean, Callie, you and I both know we hear the question all the time. How much should I have saved in an emergency fund, right? And the most common recommendation that Callie and I always give out is about 3 to 6 months, whatever you feel comfortable with. And you can get there quickly by putting away 20% of your income every month. That's just a rule of thumb. And it's part of the popular 50-30-20 rule where 50% of your budget goes to essentials like rent or food, 30% to discretionary spending, and another 20% to the savings. Now that's not always doable. That's a big number for a lot of people. So it's best to just really start with what you can based on your budget, really. And over time, you'll see that money add up pretty quickly. One tip I also find in helping to motivate people to save is to name that emergency fund something tied to an emotional need. Like if you call it never miss a rent payment, or I like no holler back girl. Callie, I don't know if you get that reference to No Doubt song, but anyway, that's just me, the straddling the millennials and Gen Xers over here. Anyway, since looking at the bigger picture though, here domestically in the US, since the pandemic started, savings rate have risen. And guess what? Deposits at banks in the US have increased also. So some people are starting to think about, they've got their emergency fund and they're starting to think about extra cash, or they just have extra cash and they don't know what to do. And I think a lot of times for younger people, there's this internal debate of, do I save first or do I invest first? And the answer that I always come up with is, well, you can do both at the same time. You know, commit to saving a certain amount each month and stick to that plan for sure. But then you can start thinking about the rest of your budget and a select amount you'd feel comfortable with investing in the market each month. And then you just kind of take it from there and revisit it occasionally once you reach maybe a certain threshold in that emergency fund that we talked about. Maybe you get three months or 2 months in and you feel a little more comfortable putting a little more towards investing, but always keep that saving bucket going. But anyway, those are just some quick thoughts that I've been thinking about money more recently. Callie, how's the pandemic made you rethink money and your financial situation?
You know, Lindsay, that's a really good question. And by the way, I do know No Doubt and Holla Back Girl, of course. Dance to it, my 8th grade dance. I know it. That probably showed my age there. But, you know, we've had to do a lot of thinking. Matt and I have really had to reevaluate our budgets. And like I said, we're not going out a lot these days. So it's been a little bit easier. But let me share one tip that we've, done during the pandemic that's helped out a lot. And it's just a small thing. It doesn't, at first, it really doesn't net much, but it has been a good psychological change for us. So as Lindsay mentioned, saving is very important. You got to prioritize the emergency fund, especially these days, when things are so uncertain. Like Matt and I, we're lucky in that we both still have our jobs, but we've had to prioritize saving more because honestly, we don't know what could happen. And that's true any day, but it's especially true these days. So we have, looked through our budget, seen where we can kind of like save money. But, we've also tried to pay our future selves first. Now, what do I mean by that? I mean, when I get my paycheck and when Matt gets his paycheck now, or I'll say before the pandemic, this is what we did. Before the pandemic, when Matt and I got our paychecks, we would pay our credit card bills, pay our rent first, put aside some money for discretionary spending, like, I don't know, clothes, bar tab, anything like that. But now in reevaluating our budgets, we've had to, kind of pay ourselves first. That means we have automatic deposits going out to savings to my 401k plan, a retirement savings plan, and our brokerage, our investment brokerage account. So that's what I mean by paying yourself first. Like, make sure your future self or your saving and investing self gets that money first, and then pull out your spending and pull out your saving. And why? Because saving is just so important. You got to have that emergency fund. It makes you feel so secure. It lets you take on more risk in your life and in your investing portfolio. So you really need to prioritize it. And I know it's hard these days, but do as much as you can. Start early and start a little. Start by saving a little. And as you can see, I think Eric popped up a chart. It is so important to start early and be patient. It's even if you have just a little bit to save, even if it's just $20 a month or something, that adds up, especially with the power of compounding. So we can talk more about that later. But Lindsay, I want to talk to you about debt. Tell us about debt. What do you do with debt in these days?
Yeah, it's a great question. And actually I saw a question come through in the YouTube chat box asking about how debt falls into that 50-30-20 rule. And I'll go ahead and answer that now. It falls in that 50% bucket in your essentials bucket. So, like I mentioned, food and rent, it also minimum debt payments on that high interest debt should fall into that bucket. But what I would say, Callie, to you is that I think about that really in the same way I did, mostly really in the same way I did pre-COVID. Look, not all debt is bad. You just really need to understand the different types of debts you have, whether it's school loans, mortgages, credit card debt. Know what the interest rates are. That's the most important component on each of those. And plan for paying down debt with the highest interest rate first. And of course, make your minimum payments at least on all outstanding debt that you have. But the twist now, the way I see it is that interest rates are still near historic lows. You should consider calling your lenders to refinance some of that debt, whether it's your mortgage or you call your credit card company to see if there's anything they can do for you on that interest rate. Those are easy places to start. You don't ask, the answer is always no. But so that's where I stand on debt. But keep the questions rolling in those chat boxes and comments on Facebook and YouTube, please. We can't wait to answer them at the end of the day or at the end of this presentation. Let's go on and move on to another hot topic, though, guys. Since the pandemic started, housing has been a boom. Brian, tell me about it. What are the key drivers? Why is the housing market on fire?
Well, the biggest one, and the one that I took advantage of, is the lowering of interest rates. The 10-year being around 80 bips at this point. I actually refied my mortgage, and I know that a lot of people are doing that. There's been a flood of refis. And then you throw in the fact that this work from home environment, people have time on their hands. The fact that they're not commuting to and from work, they're even actually getting discounts on their car insurance because nobody's driving at this point in time. When you get that amount of time, you get the concept that a house in the suburbs is a little bit more interesting than it was before the pandemic. And boom, all of a sudden, housing stocks are leading the way to the upside in this marketplace. So overall, the pandemic has been good for the housing market in general.
Yeah, it sure has. Callie, this pandemic, what do you make of it? Is it a pandemic-driven story, or is it millennials coming of age story?
Yeah, that's a really interesting question, Lindsay. And I honestly think it's a little bit of both. I mean, the housing market during this pandemic has definitely benefited from historically low mortgage rates, thanks to the Fed lowering rates to zero. Mortgage rates are a little bit higher than zero, but anyway, they're still historically low. And there's just such a big appeal, especially for millennials like me, to buy in and get a house these days. Because number one, we're in the house bored, and we're bored in the house, and we want space. We want a lot of space. I mean, I have a dog. I want a yard. And Matt and I have talked about, maybe buying a house. We put that decision off. I can talk about it a little bit later. But, we have low interest rates. You have that desire to get more space. You have millennials that have been priced out of their markets for so long, their local housing markets. And, things haven't quite helped there, but having a lower mortgage rate does make that monthly payment a little bit easier. So there's lots to consider here. And like I said, I mean, I feel the temptation. We've talked about maybe looking at buying a house, but we've decided to wait. And I'll tell you why. because, even though we want the space, we're just not ready for it yet. We don't want to buy in or buy a house just because the market is at a certain place or mortgage rates are at a certain place. We don't really have the time to take care of a house right now. And, a house, like everybody says, is a great store of wealth. I'm not refuting that at all, but you just have to have time for it, or it could become a huge sacrifice and a money pit for you. So right now we're choosing renting this condo in Uptown. We kind of value our time and our flexibility right now. Maybe in the future we'll be house people, but we're not quite there yet. So, I think it's a little bit of both, but I guess my message here is don't rush it and don't feel bad if you're not jumping into the housing market like everybody else. That's okay. I'm right there with you. But speaking of jumping into the housing market, you just bought a house, Lindsay, right?
Yeah, I did just buy a house. I guess I'm a case of the classic late blooming millennial. My husband and I, we just bit the bullet and moved out of New York City after 15 years, and we bought a house in the suburbs of Charlotte. We didn't move because of the pandemic, but in a way, it kind of like validated our decision, I guess. And it's interesting. I was reading some research recently, and Barclays has coined this type of movement, the great nesting. So moving from big cities to suburbs. And I kind of like that. It stuck with me. Anyway, Callie, I do think you touch on an interesting point, the rising home prices situation. In August, I looked at the existing home price numbers and they increased 11.4% year over year. And that was the 102nd consecutive month the prices rose. So that helps boost the net worth of those that are already homeowners, like you mentioned, but it also makes it a little more difficult for others to enter the market. So there's this concern about rising delinquencies also within the housing market with eviction moratoriums that are starting to expire and what that's going to mean for the market. When I looked at the Barclays report, they still expect home prices though to rise 5.1% this year. And then that will continue at a pace of 3.9% in 2021. So slowing a little bit, but still 3.9% is a pretty good clip for home prices to rise in a given year. And Brian, like you mentioned, I think interest rates, they're going to really play a key role in where home prices go from here. So a lot to watch in the housing market, but the momentum seems to be there within that marketplace. All right, guys, let's take another poll because that first one was pretty fun. Eric, could you put up the next question that we've got here? All right. Did the pandemic sell-off increase your interest in the stock market? As I mentioned before, go to ally.com/live poll, or if you're in the YouTube chat box, you'll see a link to answer this question. Your answers are yes or no. Did the pandemic sell-off increase interest in the stock market? I'm going to give you guys another minute or two to answer that. I want to, while we wait for them, why don't we just talk about how each of us are feeling about the market? Brian, how have you felt about the market? We're like practically back to the most recent all-time high, which was hit in September. How do you feel about that?
Well, in general, when you think about the interest of the market, as far as to go along with the poll question, we did see the big downturn in March, and we had a lot of the financial media and financial stations talk about an opportunity of a lifetime, which is for young investors overall. So I think it actually drove a lot of people into the marketplace. And in general, I think it even increased my interest in the market after we saw the little bit of the downturn. And I actually added some funds that I actually had sitting in cash and was able to invest a little bit more. But it's a lot of a FOMO trade in that, and I'm going to take that from the millennials. I didn't actually know what a FOMO was until we had a digital conference and we talked about it, but the fear of missing out. And I really think that that is a trend that happened with a lot of people, in that you kept hearing an opportunity of a lifetime. A lot of people were missing out. And in some ways, since the downturn, since the pandemic, it's actually been fairly simple, and I'm using air quotes, and we're also talking about in hindsight, but Lindsay and I, back on the 23rd, talked a little bit about Home Depot. And I remember that discussion that we had, Lindsay. It was kind of, it was the first weekend that we were work from home. And I did, I guess, what everybody else did. I didn't know I was following this trend, but I went to Home Depot to try to get some stuff to work on the house, and I couldn't park. I've never seen the parking lot that full. So I actually kind of talked to Lindsay a little bit about it. And it just happened that we talked about it on our stock play of the day, which is on the Ally YouTube channel. And since that time, that was actually about the low in Home Depot. It was around 157 at that time. Now, a quote just the other day was that it's up over 280. And so, in theory, in some of the ways, when you think about this investing, it's been simple in that if you consider who is essential and you try to figure out those companies and what the trends were going, if you were just investing in those essential companies, you've done fairly well. Now, in hindsight, that's 2020, right? We're going to talk a little bit later on about some of the stocks, particularly in the travel industry, that haven't done as well, which you might thought of have bounced back. But overall, people just not necessarily looking at fundamentals, just trying to look at what's essential has really driven this market to the high side, those type of companies. So there's been winners and there's been losers, but we'll see what happens going forward is more of an interesting concept now that we've had this big rush to all of these quote unquote essential companies going after the pandemic that is driving the market a little bit higher.
Yeah, I think you raise a good point, Brian. It's essential companies, and it's companies that can really thrive in a market like this. Technology we've seen has done really well, but it's not a tide that has lifted all boats, we should say. Even though the market is near new highs, not all stocks are. We're seeing breadth of the market, the number of companies doing well, improving, but it's still not where you would think we would be at these levels or this close to highs in the marketplace. Callie, why don't you weigh in? It looks like we're getting a slowdown on the pool question here. The pandemic seemingly has increased interest for most of our viewers in the stock market. I can't say I'm surprised. What's your thought on the interest in the stock market these days?
Yeah, I'm not surprised by that at all. Personally, I've had a lot of family and friends ask me about the stock market. Over the past few months or so, I had a little sister, who asked me about what the hot stock is these days. And I've gotten that more than once. I hate to kind of point her out there. I'll counter Brian here. And, I'll also just say I have a different personality and investing style than Brian. Brian is very good at picking out opportunities, being the good active trader, which we'll talk about a little bit more later on in the active passive debate panel that Lindsay will tell you about. But, my investing style is to kind of set it and forget it. And when I say that, I mean, I like just spreading my money out among a bunch of different stocks, maybe in an index fund or something, and just letting it sit. I have a lot of goals years and years ahead, like buying a house. So I don't need to touch that money right now. And I prefer not to touch it. I have way too much going on, especially with a puppy. So, when my friends and family ask me about finding the hot stock, that's actually what I tell them. I say, well, it depends on what you want to do. I'm like, you could be that trader who tries to find that hot stock. But let me tell you, it's really hard to do. You hear about the successes, but you don't hear about all the losers that have to go through. Losers is not the right word, by the way. I'll say failures, losses, whatever. You're not a loser if you're an active trader. But, a lot of people find success, but a lot of people also find failure. And you have to want to watch the market. You have to use a lot of time to watch the market. So I try to tell them, there's also this thing called passive investing, where you can just toss your money into an ETF or a mutual fund and let it sit through market ups and market downs. That's what I do. And like I said earlier, and maybe Eric can throw up that chart again about starting early, but other chart, Eric. Yes, that one. There is something to be said for starting early and just waiting, throwing your money in an S&P 500 fund and just, adding money every once in a while through dollar cost averaging and just letting it sit. And that's what I try to remind people, when they're new to the stock market. You don't have to chase the hot stock and the hot performance. You can take this set it and forget it approach. In fact, I do it, and I watch the markets every day. So I think that's really important. And I'll add another thing too. You may have missed buying at the drop, but that's okay. Compounding can still work in your favor. Albert Einstein once said it's the eighth wonder of the world, and it's truly hard to comprehend how much that helps you if you just be patient. So yeah, with that, I'll pass it back to you, Lindsay.
Yeah, I mean, that is a great segue to remind our viewers that we are going to have an active debate about the active trading and passive trading strategies and which makes the most sense. I think you'll be surprised at what the outcome might be. So tune in later. That's going to be at the end of the day. I think around 2:30 it's on the agenda. Our very own Frank Litke and Steve Chappell from VectorVest. So looking forward to that conversation. I would also just say that, this interest in the market right now, we've seen it here at Ally Invest. We've seen a lot of people pile in both in self-directed and our managed portfolios, which is our robo-advisory accounts. The interest has definitely increased. And, we're excited that people are excited about the market. And that's what the three of us here do, is we're here to educate, especially newer, well, for Callie and I, newer investors. Brian takes the more advanced approach to really just educate about investing. So we're happy to have all of you here today. It obviously means you're interested in investing too. So thank you for being here for that. I think that the market really created this interesting opportunity for a lot of people to get involved back in February and March. We had been on a tear, 10-year bull market. The run was just kind of getting what seemed exhausting. A lot of people felt like they missed out and they weren't able to buy in at the valuations and the prices that they wanted. And that pullback created the opportunity. So that's kind of how I look at it in some regards. But speaking of investing, what I always like to talk about, I like to hear from everybody, is especially people like us that are out here talking about and looking at the market all the time. What was the first stock or investment that you ever bought and why? Brian, you tell us first.
All right, I'm always happy to answer this question because it is seared in my memory, because I do remember that I was a young broker at Charles Schwab in the early 90s. There I am dating myself, just fresh out of college. And I was working a little bit of the later shift at Charles Schwab and Company. Now, I realized back in that day, there was no internet. Everybody had to call to place a trade or ask a question. There was no going online to find that answer. And I was working with a man that I still respect a lot. He has passed since then, and his name was Joe Heed. He was retired and was financially sound, but he was paying for his 8th kid's college. And I still remember that. He paid for all 8 of his children's college education. And I had finally saved enough money to buy stock. Now, I'd already started in my 401k and did the investing in the mutual funds, but I was all excited to buy this one stock and I jumped in on it. I can't honestly remember what the stock was, but he laughed at me and he said, "Why would you ever buy that company?" And I just kind of looked at him with a little bit of surprise. He says, "Why don't you check out this company?" And I got a quote on it and it was trading for $7,000. And I went, "Oh, I can't fathom why I would ever buy one share of a $7,000 company. I need more upside on that underlying stock." Well, that company was Berkshire Hathaway. And just the other day, I went and got a quote on it, and it's trading for $313,000. So if I had just bought that one share and held it, I would be up about 44 times on my money. And that one moment in time taught me a lot about buying the need that we feel as beginning investors to buy 100 shares of something. It's not necessarily the case if you can find a good and solid company to make your investment on. But I still remember that story, and I've told that to many times. And God bless Joel Heed, may he rest in peace. But I really still appreciate his knowledge when I was that young man back in the early 90s at Charles Schwab.
Hey, Brian, hindsight, it's always 2020.
Yeah, it is.
But you also just kind of made the case for passive long-term investing. If you bought that one share at $7,000 back then,
Yeah.
$300,000 today, man, that's a pretty good return. Anyway, I'm like probably most traditional people. I started investing with my 401k plans at different jobs, and just took it from there. But I really started investing on my own in my probably early to mid 20s. And I think that was two things. There were two reasons for that. Is when I felt like I had enough discretionary money to take on the risk and in the market on my own. But it was when I felt like I had learned enough about the market to test it out on my own. So I felt a little more comfortable with it. Anyway, the first stock I ever bought was Netflix. I still own it today. I'm proud to say. I don't like to call myself a set it and forget it type, but I am a long-term holder. So I do check in on my investments on a regular basis. And Netflix, they did report earnings on Tuesday. I will say, I didn't see what the stock's doing this morning, but it was down yesterday pretty hard on the news. It was a bit of a mixed report. They missed new subscriber growth, which is an important number for that stock and for that company. The guidance was decent, but Wall Street didn't know what to make of it. Anyway, regardless, even though it wasn't the best report, the stock is down on the back of the report. I'm still holding it. And let me tell you why. It's because I like the story. They are working very hard to improve margins, which is going to help them improve cash flow. That's an important component when you're thinking about investing in stocks. And really, at the end of the day, they have they're one of the best content providers in the business. And because of that, I do think that people are going to remain addicted to Netflix. They're going to continue to subscribe. The net ads might slow down, but as long as the content's there, I'm going to go ahead and continue to believe in Netflix. So that's my story. Callie, what about you?
Well, it's interesting that Brian brought up Berkshire Hathaway. So let me tell you, I was a nerd from the beginning. And when I was younger, I'm talking like 8, 9, or 10, I used to look at stock prices in the newspaper. I know.
No way.
Yeah, I'm not kidding. You can ask my parents. I used to read our local newspaper cover to cover. That included stock prices. And I used to marvel at this stock that was like $10,000. I was like, why is it $10,000? And most of the other stocks are like $10, $20, whatever. But that stock was Berkshire Hathaway. And I always kept that in my mind. I did not buy Berkshire Hathaway, never bought Berkshire Hathaway shares. But, I always kept that in my mind as like, what's going on there? And that really piqued my interest in the stock market. And in college, I studied journalism, but I also took business journalism, and that helped it even more. I really like, just how nobody has really mastered the markets, and we're all kind of learning every single day. And there's just so much more to learn, even if you've been in the business for like 50 years. So yeah, the first stock I owned. So I actually started investing in my mid 20s, just like Lindsay. Coming out of school, I didn't really prioritize it. To be fair, I was also making like a dirt poor salary in New York. But, I actually got my act together and started investing a little bit at a time in my mid 20s. And the first stock I bought was SPY, which is the Spider S&P 500 ETF, which I think is super lame. That's my story. But also, like I said, I'm a set it and forget it investor, and that's worked really well for me. So yeah.
That's awesome. I love that story, Callie. I just had a visual of you as a child reading the paper.
Yeah, I think stock quotes is actually not even in papers anymore. I still remember that when that was such a big story that the quotes left the newspaper and they stopped doing the quotes in there because people stopped using them. So that's awesome to hear that, Callie.
Doesn't Barron's still have them?
Barron's does. You're right. There's some papers out there that still have some quotes, but overall they've kind of gone to the wayside. There's definitely no more option quotes in newspapers, and they used to have option quotes back in the day. Me being the option trader on the panel.
That's right.
Mm-hmm. I'm dating myself once again. I'm the Gen Xer.
You are. You're showing your age, Brian. What do you, Brian, though, think about the excitement about investing? We talked about what's driving the investing, but do you think it's a reason that people should start taking caution? Because when there's exuberance in the market and retail investor sentiment reaches higher levels, usually it's been an indicator that the market could go the opposite direction.
Yeah, and well, we're seeing some good signs in the market recently. One of the things that we see that has been good recently is we're seeing the Russell 2000 index, the small caps, actually kind of leading the way to the upside. But we still have a lot of nervousness in the marketplace, and the biggest one is the VIX. We talked about the volatility index and how it's sometimes referred to as the fear index. I plan on talking about the VIX a little bit more at the end of our panel here. But as the story goes, way back in the 1929, when Joe Kennedy was getting his shoes shined, this story I think can kind of apply here. When
Hey,
we
wait,
saw
Brian, who's Joe Kennedy?
Joe Kennedy happens to be JFK, that happens to be JFK's father. So this is the story about how they actually kind of built their wealth. And part of that story is when Joe Kennedy was actually getting his shoe shined. The shoe shine boy was giving him stock tips, and he thought that this was a sign that there was a little bit of irrational exuberance, which I don't even know if that was a word back in 1929. But at that point in time, he decided to pull all of his money out of the marketplace, which he had done very well overall. But there's there's a lot of backstory to that. But if you think about it, I've kind of had that experience nowadays just after the pandemic. And Kelly has already mentioned that she's had a lot of her friends already ask her about investing. And I personally have had a couple of friends that I know that haven't invested, even at my age. And they're saying, is this an opportunity? And how do I open up an account? And how do I get started? So that makes me a little bit nervous overall because a lot of people were jumping in. Now, this was a few months back, and it's all about the headlines, the opportunity of a lifetime that we saw from a lot of the financial media. And we did look at, and we talked a little bit about Home Depot and the essential type of stores that were allowed to stay open during the closure of the economy, and how in some ways it was simpler to invest. But with that, hindsight is always 2020. We'll talk about some of the bad things that have happened and some of the tough decisions overall. But if I look at the VIX index, it's still showing a lot of fear. Now, the biggest reason why they call it the fear index in general is that more people use options for protection than speculation. Now, a lot of people don't think of options that way, but that's where they first came from, the need to protect as opposed to the need to speculate. And so when you see that volatility index as high as it is, right around 29% implied volatility as of this morning, that's just showing you that there is still a lot of nervousness. And even though we're close to all-time highs in the S&P 500 index, people are very nervous about what's to come in 2021. And I feel like the shoe shine story is a little bit like the millennial story about a lot of people jumping into the marketplace because it's an opportunity of a lifetime. So there's where my nervousness comes from. But we still have some positives. I don't want to be all bearish in the marketplace overall, because as I mentioned, the Russell's setting all-time highs and driving this market a little bit higher. There are some good signs overall in the marketplace. So right now, I think is a pivotal point going into 2021, into the end of the new year, as to where the markets are going next. And they're actually sitting a little bit confused about that overall. The marketplace in general has just, one day it's about the stimulus, the next day it's about the election. So we're getting a lot of volatility in general, just in the marketplace right now leading into this election.
Yeah, I think that there's a lot of things moving the market, at least in the near term, which is why I say once we get past the next couple months, I think there'll be a lot clearer of a picture for investors to consider when they're thinking about investing. But Callie, how do you think about investing when you see this much excitement in the marketplace, especially from retail investors?
It's a tough environment, Lindsay. And, like I said earlier, I'm glad to see people are so excited about the stock market, but it does add that really curious angle of, are we getting too excited? And the one thing I want to add here, or, just point out is, if you're an investor right now and you're worried about where the market is going, think about what you're investing in and why you're investing in it. Think about this. So as of September 30th, the S&P 500 was up about 4% year to date. Believe it or not, I know that's crazy after everything we've been through. Still, about a third of S&P 500 stocks were down more than 20% year to date as of September 30th. So there haven't been winners across the board. Maybe the general market is up, but you could be somebody holding one of those stocks that hasn't quite fully recovered. And that's why you need to step back and look at your plan. Think about why you are investing in what you're investing in. Unpredictable things happen. 2020 has showed us that. If you were an investor and COVID happened in February and March, you got caught in that sell off, it probably rocked your world, especially if you were a shorter term investor and you were planning on getting out of stocks as stocks were selling off. So think about your plan, stick to your plan. Don't make emotional decisions. And again, think about what you're investing in and why. Also, this is such boring advice, but I'm going to throw it out there anyway because it's so important. Diversify, spread your money out among a bunch of stocks, or, look at stocks, but look at other asset classes like bonds, gold, real estate, stuff like that, because that's super important too. And that's how you help yourself stay away from making emotional decisions. And it's really easy to do that these days. There are ETFs and there are mutual funds out there. I know I'm a little biased because, again, I'm a set it and forget it investor, but I think that's super important. And that's helped me a lot in looking at these markets and not feeling totally sure about where they're going. I've reminded myself that I am set it and forget it and that I don't need to touch this money for a while. So, I'm just going to let it ride.
Golly, Jesus, I thought we were going to get through this whole panel without using the word diversification.
Oh, I know, slapping myself there.
You got it in there, though. I like it. That was good. That was great. A great point that you made there. Both of you, really great points, too, about where we're at in the marketplace, where we can go, and just really about the psychology and mindset that you need to have when you are investing. It can be very emotional and very nerve-wracking, but you got to find a way to remove the emotion from the process and remember your goals. You guys summed it up just wonderfully there. Now, I do want to talk about, though, we've kind of been talking about people that have stayed in the market, but the sell-off in February and March, it was scary, I think, for a lot of people, and shocking, especially for those that haven't been through something like this. So, I do think there are some people in the position that are, probably sold back near the lows in March and still haven't gotten back in, even though we reached new highs. So the question is, how do you think about retirement during periods like that? And I want to get it from both the millennial perspective and an older generation perspective. Kelly, let's start with you. Give us how millennials should be thinking about retirement if they have missed that big opportunity back in March.
Yeah, definitely. So I have a really easy answer here. If you're in your late 20s like I am, or if you still have 30 or 40 years until your retirement, you have it really easy, but this is also the most important time for you to prioritize retirement. Why? Because you have time on your side. Remember compounding? We talked about that earlier. When returns build up like a snowball effect, as you keep saving money in your retirement account, well, that's on your side. And like I said, if you're like me, you probably have 30 to 40 years of retirement. That is some sweet time for compounding. But I will tell you, that's why you need to prioritize it right now. And I know it's really hard because things are uncertain. And you can say, that's so far off, I'll deal with it tomorrow. Well, I'm telling you right now, please prioritize it. Retirement should be at the front of everybody's minds, no matter what age you are. And as you're seeing on the slide that I think just popped up, time is money in investing. If you start even just 5 years earlier, that can mean so much more in returns, hypothetically, assuming things like an 8% annual return or something like that. It can mean so much. And that's why it's so important to start early. Protect your retirement game at all costs. Also, it's important to remember too, that some companies are giving matches on retirement money as well. Like, for example, I can't use Ally, but, for example, some companies say, if you put 5% of your salary into your retirement account, we'll match 50% of that. So 2.5%. In terms of returns, that's huge on your money. And you also have things like tax advantaged accounts out there, which also help you save a little bit of money. So I beg you, please prioritize investing if you're in your retirement investing if you're in your 20s. It's so important. Protect that retirement game at all costs.
Yeah, that's a really good way to look at it from a younger perspective. Retirement, it's hard for younger folks to think about saving for retirement because it's so far away. It's one of those things, I'll do it later, I'll do it later. That's kind of the answer that you think about when you're in that cohort. But it's something that you need to start earlier for all the reasons Callie listed. But if you're closer to retirement, it can be a little bit more of a scary picture. Actually, I've been getting questions from my parents and older relatives about this. Both of my parents are retired, and back in early March, we did review their portfolio, and I helped them to make a couple changes and keep them on track without letting them panic, also calming them down, right? But overall, their financial advisor had them mostly on track, which was a relief. There were a couple questionable investments in there, but that's a story for another day. But overall, the retirement picture, when we think about it in America, it doesn't look great. It didn't look great going into the pandemic. And the sharp sell-off in February, March, it probably dealt a blow to a lot of those retirees that got shaken by the swift move that the market did make, and especially those that sold out and never got back in. Also, if you think about it, the economic slowdown, it's hurting the job prospects for older Americans more than some other age groups. And that could also lead to a further setback for some retirement preparedness for this group of people. And, you know, while other people might still have some retirement savings, they don't have enough. So what do? I think people in the last position, the ones that don't have enough saved for retirement and are getting very close to retirement or are in retirement, usually what you see is like three different types of people. You've got the defeatist. They're the person that just gives up, throw their hands in the air and says, you know, I'm just going to have to rely on my kids or somebody else, the government, to take care of me. The second group of people, they're a little bit of a hustler. They can be kind of scrappy, and they're going to keep on working for as long as they can to keep bringing income in. And then the last group, they're really just praying and hoping to God that their investment portfolios do the heavy lifting for them. And by some miracle, they're invested in the right asset classes and they have great investment picks, and they're going to eventually make up for the shortfall. So they're kind of a little more hopeful. I don't necessarily know that any of these are really great strategies for retirement, but there is something else that you can do to prepare for retirement if you are, or your parents or someone older that you know is getting close to or is in retirement. And what we say is some of the things that you could think about, instead of just picking one of these paths, work forever or mess around with your investments and hope something good happens, you can consider doing a little bit of a couple different strategies. You know, what if you're willing to cut your standard of living just slightly when you're in retirement? And maybe you do work a little bit longer, maybe not forever, but maybe you have 5 years extra that you weren't initially planning for. And think about investing a little bit better. Get advice from a professional to guide you through the process. I think taking small steps like this and thinking about it in these different ways can help individuals really think about retirement in a different way and calm them down, especially if you're close to retirement. It's better to have a plan than be relying on a Hail Mary action. Let's all be honest there, right? Employing more modest changes around the margins of your plan, that means you're more apt to and more palatable from a lifestyle perspective too for you. So that's just something to think about. And it's just a reminder to investors that prefer to be hands-off. You can't set it and forget it. I really think that's the lesson that we should have learned over the last several months. You need to check in and make sure your plan's still working for you. If an environment changes like it did drastically for us in February, March, it's usually a good time to check in on your portfolio and make sure it still aligns with your goals. So that's again, just some food for thought for those that are close to retirement or have loved ones and family, friends that are close to or in retirement. We want to make sure we cover that. Brian, I'm going to ask you one final question before we start taking questions from the audience, because we only have about 15 minutes left at this point. You sort of mentioned options there a little bit, but I wanted to bring it up because it's also been a hot topic, a hot trend for investing more recently. Your book, The Options Playbook, which you can get on Amazon.com, it's selling like hotcakes. But are people using are they using options for the right reason? Are they using it for insurance? Or are they using it for speculation?
Excellent. Thanks for mentioning that it's selling like hotcakes, and we are actually sold out at this point in time since the pandemic. But we are printing more, so there will be more books coming shortly. Yeah, options as insurance versus options as speculation. Now, I've already kind of addressed this. At this point in time, when we see the VIX this high, it usually implies that more people are using options as they were first intended to insure themselves against a downward move in the marketplace. Now, the VIX index specifically is calculated off the options in the S&P 500 index, the SPX. And if you look at the SPX change, this has always been the case in general. There are more open interest on the out of the money put options, and let's just say going out 30 days in time, which that's what the VIX is calculated off of, than the out of the money call options. So what does that mean to me? That means that a lot of people are buying those puts, and in general, a lot of times it's institutional investors, and when they're buying them as protection. And the more and more people that go in and buy put options, it doesn't really have any regard to direction. It's going to inflate prices on both the call side and the put side. And that's part of the reason why we see the VIX at the level that it is. And because of that, that's why we get the concept of it being the fear index. That's why a lot of financial media will actually reference it that way. So in general, from my history of looking at option trading and option trading volume, I think that more people are actually using them as protection than for pure speculation. Now, with that said, the fact that the VIX is this high, it still kind of hints that since the pandemic, the buyers of options have actually done better than the sellers, because after the pandemic, we actually had more volatility than less. So if you got the direction right and you were buying option contracts, you should have succeeded in general better than the actual sellers of option contracts. And with all that said, we're seeing record numbers in the options trading world. As a matter of fact, from a business wire here, I see from the Options Clearing Corporation that tracks volumes, in August of this year, they actually were up 29% relative to the August of the year prior. So overall, we're seeing that volume increase. We're seeing that happen here at Ally Invest, and a lot of people are using options, and I love to see it.
All right, let's get to the Q&A. Thanks, Brian, for that response. We've got a lot of questions. We're probably not going to have time to get to all of them, but we're going to do as many as we can. We'll try to give quick, concise answers. First, we got a question on Facebook from Michael Kaz. Is this a good time for a new investor to begin buying stocks? Callie, why don't you take that?
Yeah, definitely. Thanks for the question, by the way. And yeah, I mean, it's never too early or too late to start investing in stocks. Just like I said earlier, remember why you want to invest. I mean, it sounds like you want to invest now, but what are you looking forward to in the future? Are you wanting to buy a beach house? Are you wanting to save up for a car? When do you need that money? I think that's something you should consider before you decide how you're going to invest. And based on that, when you need that money, that can drive your decision on when or where to put your money. You know, if you want to be that set it and forget it investor. By the way, Lindsay made a very good point. When you get close to when you need your money, you should not be set it and forget it. You should be a little more active and watch your portfolio more. But, you know, when you're years and years away from when you need that money, you just know what you're saving up for, what you're investing for. And if you are years and years away, just consider, you know, maybe spreading your money out among a bunch of stocks. And, you know, with your money too, don't invest your emergency fund. If those are savings that you need, those belong in a savings account. They do not belong in the market. So, with all that, I know it's confusing, and you can also get a professional to help you here, but it's never too early to start investing, and it's never been easier. So definitely start and do a little at a time if you can.
Okay, next question. I invest heavily into my 401k and I'm building my emergency fund. What are some ways to get into short term investing outside of my retirement account? And what I would say to that is open a brokerage account, open your own investment account, and start small. Because if this is the first time you're doing it on your own, you do it just like I did it. You start small. You start with something that you know, something that you understand, a company, a stock that represents a company that you used or have a good understanding of, or have done a lot of research on. Get used to the feel of the market, and then you can then build the amount of money you have in that account and continue to invest in other areas. But it is important to have an investment, a separate investment account outside of your 401k, or what Callie just kind of talked about, which is if you have shorter term goals, you're not going to be able to pull money out of your 401k without a penalty or taxes for the most part. So this allows you to have to fund goals that are, I wouldn't say short term, 5 years or more. It's a good way to think about the market. So that's my answer to that question. What else do we have? Let's see.
A lot to choose from, Lindsay.
What's that?
There's definitely a lot to choose from out there. That chat box is just rocking and rolling.
I know. If there's one that you saw at Ally, I'm 21 years old, college student. What really is the route I should be taking into investments right now? I think I probably just kind of answered that. Start small and start with what you know, and take the time to learn and educate yourself. There's another question in here about how do I become a financial expert? It's all about educating yourself. You can look to thought leaders and professionals like us to help explain things to you. Callie and I put out our weekly viewpoint every Friday. It goes on our community hub website, which I'm sure someone can type into the chat box if you want to check that out. There's a ton of really great information there, from personal finance to investing, that can answer a lot of the questions that you're asking here that I would want to highlight for you guys. But there's also, why don't we go around and talk about some of the books that we would recommend to help these folks educate themselves. I'm going to start with a book that I just recently finished reading that I thought was really good, and it's called The Women's Guide to Successful Investing by Nancy Tangler. I've actually met Nancy before. She's incredible. Even though it's the women's guide, I think it's a great book for anyone. It kind of breaks down investing to a very basic level and helps you understand and think about how to get started. Callie, what about you? What book would you recommend?
Oh man, I have a few. So I'll throw out the classic one. Rich Dad, Poor Dad is really good. I can't remember who wrote it, but it's basically the story of a guy who, is young and he sees all his friends with like houses and boats and, really nice stuff. And he has one dad who is a teacher who is teaching him how to, go the traditional route, get an education, buy a house, all that good stuff. But he has a friend who has a dad who is an entrepreneur, and he teaches the author, how to think about money in a different way. I actually just read that, which I know is like a cardinal sin, but it is such a good book. It is a good way to, think about a different way to view money. Next on my list, I really want to read The Psychology of Money by Morgan Housel. Everybody has raved about that book, so I can't say how good it is or not, but I've heard so many good things, and it's good in showing you another way to think about money as well.
I just bought that one. I just received
I need to.
Brian, do you have a book, or why don't I ask you a quick question? You have like 30 seconds to answer, and then we got to go.
Okay.
The question is, how in the world can the financial markets continue to touch high points with huge gaps in the economy? All of this government stimulus, it seems there will have to be a correction at some point.
Yeah, but the question, okay, and I get 3 seconds. Thank you so much, Lindsay.
Sorry.
Overall, The question is there probably will be a pullback. There's no doubt about it, but how much will that pullback be? And that's the biggest concern right now. And that's why we see the VIX at the levels that we see it at. So in general, yeah, there probably will be a pullback at some point in time, but how much of a pullback will it be? And then what do we do when we see that? Is that an opportunity? And a lot of that has to do with the biggest question out there: when will we find a cure for the coronavirus? And it's, I think, a matter of when, not if. In general, there's so much money being thrown at it.
Yep, absolutely. It's always the key takeaway, I think, is have a game plan.